Welcome back. I hope you're having a fantastic day. Today, we're going to talk about AMC. What is it going to take for the stock to come back? Can the company survive and rebound? Several people have been asking me to share my thoughts about AMC. And right now, the latest news is they are raising $500 million in a bond offering so that they can refinance debt. So one of the biggest issues that AMC is facing now on this side of the pandemic and the meme stock frenzy that drove the stock to record levels is the debt that it was burdened with before the pandemic. They already had a big debt problem before the pandemic, and now they have an even bigger debt problem post-pandemic, post-meme stock craze. And that debt service and the burn rate of the company at scale as a whole is incredible. So the senior notes carry an interest rate of 10%. $500 million at 10% is no small chunk of change. That's a big debt to service. Refinancing to push debt matures out to help AMC save cash and pay down interest on other notes that are due sooner. So they're just basically playing the reshuffle the debt game to kind of keep them out of Chapter 11. They did issue more stock, as you know, that helped bolster their cash position to kind of ride out some of this storm. But unfortunately, they had a lot of debt going into this. They still have a lot of debt now. A lot of the insiders and top executives sold off a bunch of their stock. So a lot of people lost interest, and they lost a lot of support by doing that from the retail crowd that kind of propped them up. They narrowly avoided bankruptcy last year. And now they have over $5 billion in debt to deal with. And that's generally going to be high interest debt that they're having to restructure. And what is it really going to take for the company to rebound? And when you look at where it's come from and where it's gone to in the recent history, and we'll take a look at the chart here in a minute. But as far as a future for the company, there's a huge disconnect. And the disconnect is in the valuation in terms of where it can go. And I know there's a lot of talk of a massive short squeeze that can drive the stock through the roof. But the problem is the company right now, at this point in time, is trading at 27 times forecasted EBITDA. And for 2022, that was for 2022, 21 times the expected EBITDA for 2023. And historically, it's traded between 6 and 9 times EBITDA. So the stock is still trading several deviations above where it probably should be trading. And its main focus now is on repaying, restructuring debt to keep the company open, keep it rolling and thriving through the rest of the pandemic until we can get back to regular attendance at the movie theaters, which we'll look at the stock here in a second, was on a steady decline even before the pandemic. Movie theater attendance was kind of drifting down over the last number of years. So let's take a look at the chart here real quick and see where the stock is, what the chart looks like. And right now, this looks like an altcoin in the crypto space. These meme stocks, it's just incredible the bounce that they had. That was a lot of fun, going from basically $13 to $72 in a matter of a few days. And then it's just been steadily downhill ever since. Not a great looking chart at all. If we look at it on the hourly, we were down as low as $13, had a little bounce. Now it's around $15.92. If you look at it on the weekly and you look at historically where the stock came from, it had been trading, back in the 2014, 2015, 2016 era around $35, dropped all the way down to a low of $1.99. And then we had the bounce to $72. So in terms of downside potential risk, there is a lot of support in that $5 to $10, $11 range that it looks like it's headed to kind of test and see what the bottom downside risk on that stock is going to be at the end of the day. So what is it going to take for AMC to come back? Obviously, they have to restructure their debt. They have to lower their interest rates, and they have to generate revenue, right? So sales cures all. In the industry of retail, whether it's movies, retail, restaurants, there's a saying that says sales cures all. So you need top line sales, number one, to bring it to the bottom line, to be able to have strength to negotiate debt restructuring and repayment, and to convince investors that you're worthy of their capital injections and that you can actually pay it back, much less pay the interest on it. So what the movie industry needs now is we have to get back on the other side of the pandemic, get to where people feel safe going back to the movies. I'm a big movie goer. I like to go all the time. I have no problem going to the movie theaters. Been kind of nice during the pandemic. A lot of times we'll go, we're the only ones in there, or maybe 4 or 5 people in there. So kind of neat having your own movie theater experience. I'm surprised they've been able to keep going as long as they have, but they've been using the liquidity that they generated through loans, through stock sales and things like that to keep a lot of these movie theaters going. And the burn rate is it just has to be incredible in terms of the cash that the company's burning through, because there just are no sales. So what is it going to take for the movie industry to come back to survive and for these stocks to thrive? We need to get to the other side of the pandemic, get people feeling comfortable about going back to the movies. But number one is we need big movies. We need movies that are going to draw millions and millions of people back to the movie theaters. And unfortunately, it's kind of a catch-22. The actors, actresses, the movie stars, movie production companies don't want to release movies right now because nobody's going to the movies. And you don't want it to be a bomb. And the dollars that they're generating right now are just minuscule compared to what they used to. So we have to get back to a point to where people feel safe and comfortable going back to the movies, and we can bring good movies back to the theater, because there just aren't any great movies right now. So that's a little bit of my thoughts in terms of AMC, where that stock is, where it's headed. Looks like there's more potential downside, especially in light of the new economic environment with the Fed put off, with QT coming, quantitative tightening coming, meaning that the Fed is no longer going to be flooding the economy with cash. Interest rates are on the rise, which means debt payments are going to increase. So it's going to get more expensive to borrow money. And with inflation, operational costs are higher. So there's a lot of headwinds for organizations like movie theaters, restaurants, retail that they're still facing to get through this time. So unfortunately, the near term does not look good, and we might see some more downside in the stock. The company should be able to survive all this. They may have to close some theaters and restructure a little bit. Who knows where things are going to end up and how it's going to look. But I love the movies. I'm a bull for the movies. I would love to see the company rebound. But in terms of normal traditional valuations, which a lot of these companies are getting back to without the Fed put, the valuations are resetting. You have to remember that normal valuations for movie theaters pre-Fed liquidity, Fed put, was 6 to 9 times EBITDA, not 20 times and up. And a lot of companies are following the same suit. So we have to get back to normal ratios, normal valuations, normal multiples in terms of what's traditional and appropriate given the interest rate environment and given the participation or lack thereof from the Fed and liquidity going into the markets. So that's my thoughts for today. I'll see you on the next video.